Well, hello and welcome to the debut episode of the Mutual Fund Show, and it can't get bigger than this. It's probably the best time to invest in the Indian equity markets, or at least the last 12 months have shown that the time is always right every single month that you thought about it. We have a hit with demonetisation, maybe a couple of other events, but the markets have bounced back ever so well. And well, we have a very special guest with us on this inaugural episode. Needs no introduction, but S. Naren of ICICI Approved with us. Naren, thanks so much for joining in on an inaugural episode. Really good to have you.
Thank you.
So, Naren, that's a simple question, right? Markets keep on hitting new highs. Every single day people see news channels and say, hey, have we missed out on the party? The question is, either you're a direct equity investor or you're a mutual fund investor, but if you were not invested, you probably have missed out on a large part of the party.
Clearly the safer part of the party is missed out.
Okay.
Because when the markets are cheap and you invest like what I call early cycle, mid cycle and end cycle, I think the early cycle part of it is over, and today you are in mid cycle where it's relatively easy to get people to invest, but you don't have cheap markets any longer. You have markets which are either fair value or above fair value at this point of time. So the safer part of the returns are over, but we are not yet in end cycle. So that's the advantage. From mid cycle to end cycle, there are possibility of decent returns, and that's how we are looking at it.
So, Naren, the thought when we were thinking of doing this show as well was to try and reach out to as many people as possible who traditionally have not been investors in equity markets or were thinking of investing in equity markets, but something is holding them back and are looking for avenues. Obviously, one of the best avenues is mutual funds. The question to a lot of people's minds is they correlate market levels with whether it's the right time to invest in mutual funds also or not. Forget equity markets. Is that the right way to approach investing in mutual funds?
See, certainly wrong, because
certainly wrong, you're saying.
Yeah.
Okay.
Because mutual funds are not just equities.
Right.
And if you were to sell only equity mutual funds, then the market is definitely very risky.
Okay.
But any mutual fund, let's say a mutual fund, we have products which are safe debt products, we have products which are slightly more aggressive debt products, and you have products which are like both in debt and equity, like dynamic asset allocation, and you have equity. So I think it's very important to see the mutual fund industry as not just equity mutual fund, but see it as a combination of debt, equity, mixed like dynamic asset allocation, and then equity.
Okay, and we'll come to that as well. But I just want to get in one small point out here, Naren. What we've seen in FY17 is that while there is the reach of mutual funds is obviously not as high as one would like it to be. I mean, I personally would want almost each and every nook and corner of India to be invested in the financial markets, and that's something that we'll try and take the message to as well. But the inflows into mutual funds have been staggering. I think probably the highest in the last 10-11 years in net inflows into mutual funds. My question is, with so much of money coming in and so much of money that a person like you has to manage, do the markets, the equity markets, have enough depth for you to be able to allocate that money in the optimum fashion? Or are you forced by hand to probably now start taking some risks in order to park your money safely? How is it happening?
Clearly, I think one big difference is the amount of money which are coming into, I would say, products which can invest in both equity and debt, like balanced advantage, equity income, has been a refreshing change.
Okay.
So once you get money in these kind of products, you're not investing in just equity, you're investing in equity and in debt. And then obviously the risk level of a product which is partially invested in debt and partially invested in equity is definitely much better than a product which is only invested in equity. I think it's only in the pre-2007 phase mutual funds were seen as an equity vehicle.
Right.
I think a lot of effort has been made by the industry to try to see the mutual fund as industry as both debt and equity, and a combination of both like dynamic asset allocation.
Okay, so for a lot of our viewers who are watching it right now and listening to you, I actually get that feel that you probably are saying that this might be a good idea if just for somebody who's not initiated in the markets in a big way, to go out, maybe consult a financial advisor as well, but not necessarily park money in a higher equity exposure in a mutual fund. A balanced fund might be a good idea at the current point of time. Is that the sense you're giving loosely?
Yeah, clearly, we have been suggesting to people, look at the entire gamut of products which invest in both debt and equity, like equity income, balanced advantage, balanced, and not choose only pure equity products. That's been a clear message over the last month or so.
Okay. Now, when we speak to financial advisors, and I know that on this forum, at some point of time, we will also be talking to a lot of financial advisors to try and advise what funds to invest into and all. But I'm just asking you, when we listen to financial advisors, they say that, hey, if you are between age 0 to 15, and which means parents are investing for the kids, the kind of mutual fund allocation or the schemes that you invest in should be different than what it should be for somebody who started earning to what it should be for somebody who is nearing retirement and then of course into retirement. Do you internally as well think that that's the right way? Do you come out with products which are focused like that? I mean, for viewers who are tuning in right now and wanting to know more about this, would you throw some light here?
See, clearly, obviously, you can't go and invest in a very aggressive equity fund if you are 80 years old.
Right.
Having said that, I think the market levels are also an important factor. We are no longer in that early cycle. In early cycle, if you invested in any equity product and just sat on it, you would make money.
Right.
Now we are no longer in that situation where you are in that early cycle. We are clearly in mid cycle. In mid cycle, it's very easy to collect money.
Okay.
But it's not a time when the valuations are cheap.
Right.
So that phase is where we are at this point of time.
Yeah.
So I would say that clearly compared to, let's say, 3-4 years back, you should have a more conservative investing pattern today than what you would have had in 2012 or 13. Clearly, because now you're investing after a 3 to 4 year bull market, so you're in mid cycle. So I would say the more, as the cycle becomes more and more advanced, I would say you should invest in more and more defensive products.
Wow. Okay. Okay. Fair. So that's something that viewers, all of you should take on board. Naren is saying that try and invest more and more into balanced products, which brings me to a product, Naren, ETFs. Now, a lot of people, including me, don't have complete knowledge about ETFs. Would you care to explain? Because I was looking at the returns given by some of the ICICI approved ETFs as well, if I'm not wrong. The returns have been fairly strong for FY17 or calendar year 17 YTD as well. Would you explain about that?
See, I think clearly, as you know, we have had a continuous bull market,
right,
and some of the ETF products clearly are products where you don't have any cash in the portfolio, so they participated in the bull market.
Right.
Our own view is over the next 10-20 years, ETFs will become pretty popular.
Okay.
But in the near term, till maybe our industry doubles from here in size or something like that, there is still scope for active management.
Of course.
And so I would say that ETF is clearly a 10-year story, and it will keep improving and keep increasing as a percentage of the market over the next 10 years. But at this point of time, we are arguing that we are much better off being in products like equity income or balanced advantage or balanced kind of products rather than in being in ETFs, because ETFs are well suited in the early cycle when you believe in mega returns and you have to be patient. Now you're clearly in the mid cycle. So in mid cycle, we are clearly believers in dynamic asset. Having said that, over the next 10 years, ETFs are going to take off.
So the profile of the investor, which means the age or the risk appetite, so to say, is not a factor while choosing between MFs and ETFs. You clearly believe the cycle in which you are in is probably a more important factor for choosing an ETF versus an MF?
Clearly, if you look at it, age does play a role. How much is a person is dependent on the return from the investment plays a role. And today, for example, we have always been arguing that if, for example, you had a fixed deposit and you're moving to mutual fund, we have been arguing that it should be invested in products which are on the conservative side of the equity spectrum, like equity income and balanced advantage fund. Because the person who comes from a fixed deposit mindset, if you go and put that person in the higher risk product, then it is a problem. So choose the more defensive product. So I think it's also a function, you can't have a single size, single model approach. Clearly you have to look at age, you have to look at asset allocation. So people come and ask me, should I take out money from equity? I tell people, if you're massively underweight in equity, you should add to equity. If you're massively overweight in equity, this is a time to cut equity.
Okay.
So clearly a person's asset allocation has a role to play in decision, along with the requirement of age, the dependence on the income from the asset class,
Sure.
and what are the other different issues that people have to consider while investing.
Okay, that's interesting. I have some data out here, Naren. I would want you to comment. Our data shows that the banking and, the top 3 schemes of ICICI Pru as a house. There's a banking and financial fund, if I'm not wrong, which has given returns of, I think, 55%, the value fund about 39%, and the dividend yield fund about 37%. My numbers should be more or less correct? Yeah. So if their numbers are more or less correct, the interesting thing is that all of these funds have probably a different style of investing, right? A value investing fund vis-a-vis a banking financial fund, which would probably be a more aggressive fund, or for that matter, the dividend yield fund, which I believe focuses essentially on companies which have a higher dividend yield, so to say. And all of these have given good returns. Where is it that you find favor now?
See, we have been believers over the last 6 months that if people have to look at a theme, they should look at infra.
Okay.
Because it's a theme where if I tell a person to invest in infrastructure, equity fund, that person says, I had a bad experience in the last cycle. Why should I invest?
Right.
So, whereas if I go tell people in 2013, mid-cap funds and small-cap funds had no money. But today, whenever an investor meets us or a wealth manager meets us, he says, I'm willing to invest for the next 20 years in small caps. Why is it that in 2012 or 13 they were not willing to do it, but today in 2017 they are willing to do it? It's primarily the last 4 years return.
Right.
So, we are believers that if we have to pick a theme, you have to pick a theme which is done badly.
Yes.
Whose performance from here will be good.
Right.
A lot of people pick up themes after a theme is done well. Clearly, small cap has done very well.
Yes.
But small cap doesn't make sense to invest now aggressively in small cap after small cap is done well.
Right.
Whereas if you look at infra, 10-year returns are next to nothing.
Got it.
So we believe, these cycles play out, and we like to invest in themes which have actually not worked in the past.
Right.
Because we are big believers that past returns is not equal to future returns.
Of course.
And that's how we pick on infra as a theme, large cap relative to small cap as a theme, dynamic asset allocation funds as a theme. Because these are all the kind of themes we like in this part of the cycle at this stage.
Okay, and I am going to talk about the markets, wherein I'll talk about infra a bit more as well. But since you mentioned infra and a theme that you like, let me ask you, it's like asking a chef about what is his favorite dish out of the 10 things that he's made today. But what is your favorite ICICI Prudential fund, if you can name one?
See, we believe that every investor has to have...
Is that a diplomatic answer, Naren?
It's not. If a person wants to take high risk, I've been telling people invest in infrastructure fund.
Okay, which is that's the ICICI Prudential.
Whereas people want to take moderate risk, we tell people invest in equity income and balanced advantage fund. So it varies depending on each person's risk level, return expectations, etc., etc. And I think that's how we look at investing as a model.
Okay. I know a lot of people who would be watching this show and saying कि सब कुछ ठीक है लेकिन हमें नरेन जो पर्सनली फंड मैनेज करते हैं उसमें पैसा डालना है. Now again, correct me if I'm wrong, but I believe amongst the things that you manage or you look at it personally, I know you look at the house as a whole, but if I look at schemes like the Pru ICICI Balanced Fund or the Prudential Dynamic or the Prudential Top 100 funds, I believe you look at it more actively as well. Is that right?
No, I'm the fund manager of these schemes.
Yeah. So out of these, is it possible to tell people what is it that you personally think is slated for better returns? I mean, am I putting too much
I think
pressure
you
on
are expecting things which
you can't
frankly, I always tell people it's impossible to predict markets.
Of course.
It is much easier to predict what is valuation, what's a valuation and where you are in the cycle.
Right.
But I don't think you can ever predict markets. On the day after Brexit, the entire world believed that equity markets will fall.
Yes.
If you look at it, Brexit was about a year back, and from that point of view, the market just went up.
Yes.
So I think prima facie, I think it's much better to look at investing from an asset allocation lens. And from an asset allocation lens, I argue that if a person is very over invested in equity, to cut it to overweight.
Okay.
And if a person is underweight in equity, to add to position in equity, albeit defensively.
Okay.
So this is what is more clearer from a point of view to communicate, rather than pick one of my funds and say this is the best fund.
Yeah, but I think what is important to highlight though is, Naren, that if people are investing right now, don't get disheartened if the markets were to correct a bit, because it is more important to spend time in the market as opposed to timing the market.
So I have a slightly different view.
You do, okay.
I believe that we are in what we call a reflexive boom.
Okay.
Which means that as the market keeps going up, there will be more and more interest in the markets. On the other hand, if there were to be a massive correction in the market, actually investors are unlikely to be interested subsequently.
Is that the right behavior?
That may not be the right behavior,
right.
But what George Soros has taught us is that this is how investors are likely to behave.
Okay.
So what really it means is that you have to respect asset allocation. From this phase of the market, every investor has to respect asset allocation, and if that person respects asset allocation over a long period of time, they'll make money. I think I'm a big believer. Right now we are in a boom market in equity, and when you are investing in a boom market in pure equity funds, I think the returns in the long run will be average. Because if you go and look at the kind of returns markets have given in the last 5 years, it's not been small.
Yes.
So, it's very easy for you to extrapolate the last 5-year returns and say this is what you will get in the next 5 years. But I am a believer that you are likely to get more moderated returns in the long run. It is just that right now the cycle is reflexive, so the market keeps going up each month. But the long-term returns from here will be average. So for that's why we recommend investing in defensive equity funds.
Got it.
Or in dynamic asset allocation kind of funds, because we believe that the long-term returns, when you invest in a boom, it's better to invest cautiously in a boom. We have a simple principle. In a boom, you invest cautiously. In a bubble, try to reduce risk by actually taking out money from equity. In a bust, invest aggressively.
Got it.
Clearly, we are in a boom, so you have to invest defensively.
Okay, that's well said. And I know from how, whatever little I've tracked about your investing style as well, that a lot of times you, I'm not using the term loosely, but you play contra in a nice way and manage to give some staggering returns. I remember metals, I remember telecom as well very recently. Before I get to that, and I would want to speak about infra as well, I just thought to bring it out for the benefit of viewers who are not necessarily only mutual fund investors but also equity investors. I was looking at the allocation that you made within your funds as well. Financials about 25% odd, IT is about 10% odd, industrials is about 10% odd. What's your stance right now? What could do well? What will not do well?
See, right now we are in a stance that we think that small caps are high risk.
Okay.
We think that mid caps are definitely higher risk than large caps.
Okay.
So that part of it is very clear. Our view is that in this boom, it looks to us that IT and pharma can do decently but not great.
Okay.
Whereas long-term returns, when you invest in this boom, in tech and pharma should be good.
That's what I was going to ask you.
Because those sectors have become cheaper by the day.
What do you like between the two?
We like both.
You like both?
But we believe that you have to be graded in your investment.
Okay.
So because at the end of the day, this boom seems to be much less a boom for IT and pharma. If you look at the sector over the last 1 year or so, these are the two sectors which have done very badly.
Yes.
And that's why we think, if you had to invest slowly over the next 2 years, it's a kind of theme to invest in because you're buying cheap.
Yes, you are.
As such, our belief is, if you want to make very big money, you need to have fear and valuation should be cheap.
Right.
And today, if you look at it, tech and pharma would be the only two sectors where you have fear. What will happen to FDA?
Right.
What will happen to rupee dollar?
Yes.
So I think clearly over the next 2 years, I think it's the kind of sector to invest in. But in this boom, will that be the sector delivering the biggest returns? I doubt it.
Okay. You believe infra could be it?
Infra could be it.
Infra is infra could be it. And I like the smile on your face, Naren, when you're speaking about it. My question is this. Yes, infra has a lot of large cap presence, but because these stocks have been beaten down so badly in the last cycle, that a lot of them, even though they are large companies, by market cap parlance, they are mid caps.
Yeah.
So therefore, there you don't find too much of a problem. Mid caps may be overvalued, but infra mid caps could be a good idea.
They're not, because you look at the size of the infrastructure funds.
Yeah.
In 2007, those funds were 3 times what they are today in terms of size.
Wow, okay.
Whereas you look at some of the mid and small cap funds, they are 15 times what they were in 2007.
Right.
One of my gurus says you go and invest in the themes where there's no assets under management. Because those are the themes where actually you found it difficult to buy shares.
Right.
Clearly, infra is the area where you have small size funds.
Yes.
In small and mid caps, on the other hand, you have record size funds.
Yes.
So clearly, that's the way we look at it.
Okay. What within infra though? I'm just wondering. Was it pure play
See,
construction?
actually, no. We believe that that's why you have to buy a big theme. You
Right,
have to buy road construction. You can buy telecom. We do buy some corporate banks. We believe that cap goods sector will improve over the next 2 years. Power is likely to improve. If you look at metals, it's only in the last 18 months that they've delivered returns. Prior to that, there was a 10-year period where they actually gave negative returns.
You turned bullish on metals about 18 months, 24 months ago, right?
Yeah, exactly.
I remember having a conversation with you.
So we are saying that, the entire basket, if you look at it, are all stocks which haven't done well for 10 years.
Right.
So you're actually picking a theme which hasn't done well for 10 years.
Okay.
So I'm a great believer that if you have to make money, you should invest in a theme which hasn't done well.
Okay. Real estate hasn't done well. Is that a theme?
Yeah, but it's not a theme from an equity point of view because first of all, the addressable universe is much smaller.
Yes.
And most of us know that it's very difficult to make money in that sector in equities. But I think a few years from now, real estate, physical real estate, residential real estate should become cheap. We have 5-6 years of no returns in real estate. Then after that could become a cheaper asset class.
Yeah. Okay. That's an interesting thought as well. Okay. So buy into maybe some of the beaten down thematic funds as well if they are available. But just one question on that. What's the fund available at ICICI Pru House for infrastructure?
So I say we have a fund called ICICI Prudential Infrastructure Fund.
Okay.
That's been in there for more than 10 years actually.
Okay. Okay. Okay, as I said, Naren, we promise we will not take live questions, but there are 2 or 3 or 4 people who've written to us and asking us questions. So Saurabh Jain, gentleman, he's asked about infra as a theme, and I think we've just discussed that. Somebody is asking, a lady called Sangeeta Chaudhary is asking about the best SIP funds. Is there a difference between a normal fund and an SIP fund?
See, actually, I've had this debate, and my view is that in an early cycle, even there, the problem is that the last 10-year SIP returns has been outstanding.
Yes.
So I'm arguing today that you should invest SIP in a more defensive fund like an equity income fund or a balanced advantage fund. Because the last 10-year SIP returns, if you see of all the products in the market, it's outstanding. So now I believe when you're in mid-cycle, in the next 2 to 3 years, you go to end cycle and then you have a fall in the market. We think that the new SIP should be invested in defensive funds.
Interesting.
Normally, you would recommend SIP in an aggressive fund.
Yes.
But the phase early cycle is over. The past returns, you can go and look at the SIP returns on all the schemes. It's fantastic.
Yes.
So I think new SIP should be invested in defensive funds like what I was talking about, dynamic asset allocation kind of funds. Because what happens is the way we see the market is market moves from mid-cycle to end cycle, let's say over the next 2 to 3 years. Market goes up, you deliver returns, but after that you have a correction.
Yes.
When the correction happens, the SIP returns actually come down more because you've actually averaged upwards.
Yes.
So which is why we are a big believer in doing SIPs defensively from now on.
Okay. So, but and this you are recommending for all tenors of investing, be it an SIP for 3 years, 5
I would
years?
say more than, if you are a 10-year SIP investor and you're a genuine 10-year SIP investor,
right?
then I think you should choose small and mid caps as a strategy, because over the next 10 years it will be so volatile that you will get good returns over a 10-year period.
Okay.
But if you are recommending investing in SIP for the next 3 to 5 years, this is the kind of strategy I would recommend.
Okay, yeah. So that's a good bifurcation. I wanted to get that out. So thank you for that. Now, Mr. Kiran Kiru, and I think again a question that probably we've discussed, but I still want to ask you. Somebody is asking about which fund is a good investment fund from a 5-year perspective for mutual funds. I think it's a bit of a repetition, but maybe we can.
Such questions, no, I don't think I can actually answer. It would be like, if I choose a scheme, first of all,
I thought as much, which is why.
Thing. But broadly, we are believers, as you know.
Let me ask you then something which you probably be able to answer. One option that I think ICICI as a house gave to people is exposure to international equities as well.
Yes.
And if I'm not wrong, that fund has done really well.
Yes.
Now, what's the way ahead now? Would you believe that it's better for an Indian investor who is not very large, let's say, to invest in a domestic centric fund only, or is this a fairly good option even now?
See, at the time we launched our international funds, the entire current account deficit was high and currency was actually rapidly depreciating.
Right.
So, with your current account deficit where it is, which is very low, and you have a situation where crude is also range bound, we have not been recommending international funds from our basket for new investment. So I would say our thesis is if current account deficit crosses a certain percentage, then people should look at international funds.
Okay.
Right now, current account deficit is close to 0. So we are not recommending international funds at this point of time.
Okay, last couple of questions, Naren. One is there a new thematic fund that is likely to come out from your stable? I have a follow-up to this as well, but firstly this question, is there a new thematic fund that you are thinking of, because you've come up with some very interesting ideas in the past as well?
See, basically what we've been telling people is that, there's a lot of money on the sidelines because markets are at all-time high. So what we've been trying to do is actually launch closed-end equity funds, because like Value Series 14 and things like that, so that investors are invested for the next 3.5 years. And actually we can always take a decision keeping the next 3.5 years in mind, because there's no risk of redemption.
Right.
So those kind of categories we have been actually recommending to investors, because what we think is there's just a lot of money on sidelines, confused on what to do in the near term.
Even now, you think?
So,
I mean, you're talking about from an investor's perspective?
From an investor's perspective.
From an international investor and a domestic?
From a local
investor's perspective. Somebody like you.
I mean,
I'm not talking about you individually, but somebody like you. A money bag like you, who's sitting on the sidelines because he's confused as to what will happen next.
That's what we've been trying to do, because what we think is that closed-end equity funds have their own, because investor has to think for the period of the investment.
Right.
They take more involved decisions, and they know that they can't take out in the next 6 months or 1 year.
Right.
So that kind of a fund also we've been actually, so we keep launching fixed maturity plans which are closed-ended, multiple yield which have been closed-ended, and closed-end equity funds, all as a tool from a long-term investor perspective.
Okay. Finally, Naren, I just want to bring out what is argued to my mind being the most important point that you've been trying to drive in this interaction, and correct me if I'm wrong, that for people wanting to park money afresh into equity markets, or people have been investors in mutual funds and equities but want to park more money in equity mutual funds right now, getting a balance, or rather mutual funds right now, getting a balanced, making an investment in a balanced mutual fund at the current point of time is probably a better decision than having an aggressive equity mutual fund.
Clearly. We are believers not in the entire dynamic asset allocation space. So equity, income, balanced advantage, balanced, dynamic, the entire basket, because that entire basket we think is a product depending on where the customer's risk level is. Because we are right now in a boom, and we are not in that early phase where you can say invest in small caps, buy and forget. We are no longer in that phase.
Okay. Last question for the markets, Naren. We are at between 9,000 to 9,500, give or take a few points here and there, on the higher end right now. Do you think the markets are fairly valued, or do you think they are expensive, or do you think they are terribly expensive and therefore will correct? What's your prognosis on equity markets right now?
Our view is that on a price to earnings basis, the market is expensive. On a cyclical basis, we think that earnings will go up in the next 2 years.
Okay.
And decently.
Okay.
It's just like, for example, you take a sector like metals. In the last 2 years, earnings have just shot up. Like that, we think that in the next 2 years, earnings for the entire market is likely to improve.
Which means not just the Nifty 50 or the Sensex 30, but the markets.
Markets. And therefore, what we think is that over the next 2 years, from a cyclical perspective, there's good benefit. But on we are in a strange situation that even before earnings have come, the markets have gone up.
Yes. Yeah.
So, which is the reason why we recommend investing defensively in equity, because we still expect earnings to come.
Okay.
But this is a strange situation where the market has not waited for earnings to come. It has come. The market returns have come up front.
Right, of course. Okay.
That's the kind of situation we've seen.
But you're not bearish.
We are not bearish, because I think the entire outlook is to actually support financial savings.
Yes.
We are a big believer that interest rates, the more interest rates go down, the more beneficial it is for equity market. After a long time, this week we have seen a rally in fixed income. We think that even interest rates have to go down, because the entire financial savings which keeps booming, that can bring down both interest rates. Why should only equity markets go up? That's been our view. So that's why we are constructive on financial savings, but we want investors to focus on their asset allocation. We believe that in this part of the cycle, a lot of investors will forget the idea of asset allocation.
Yes.
And that is a big worry from our point of view.
Okay. So maybe trim a little bit of exposure towards equities. And
if you are massively overweight equities, I think there's a time to book some profits, particularly in small and mid caps.
Okay. But even for people who don't have any equity exposure, Naren, if they are starting off a mutual fund investment, do on a balanced fund and not necessarily.
Because you're not been exposed to equities.
Yes.
And what worries me is in the last 5 years, there's never been a big sustained drop in the market.
Right.
So what happens? People forget that equity markets can give you good corrections.
Yes.
And that's slowly getting forgotten. And that's the reason why we are recommending investing defensively.
Okay. Last question, Naren. Any good, interesting book that you've read in the recent past? I mean, a lot of people want to know what's a good book to read. Not necessarily from markets perspective, but anything that you've read recently.
No, I always tell people, go and read oaktreecapital.com's memos, which are there online and free.
Okay.
And that's been my view, because it's available free to read. And he has written over the last 20 years. So he has seen all the cycles. So that's what I keep telling people.
Okay, great. Yes, Naren, thank you so much for joining us on our maiden episode of the Mutual Fund Show. It was a pleasure having you. Thank you so much for your time. And viewers, thank you so much for tuning in.